Hello and welcome to another installment of Every Quarter. The date today is 29th January 2024. So today I just want us to quickly go through fixed term investment risk. Um, so, fixed term investments like bonds, they have a reputation for being low risk investments. I think one of the things that you are likely to come across um, as you go through, the various discussions that people have as regards fixed term investments like bonds, is the fact that they are very low risk. But that is not to say that they are without risk. I think that low risk doesn't necessarily mean that they are without risk. It is very important for us as investors to be aware of risks that are associated with the different investment vehicles that we are using to grow our portfolio, to grow our income, to grow our wealth. And in this particular episode, I want us to look at a few um, risks that are associated with fixed income investments like bonds. So, what do we mean by risk? By risk, I'm talking about the possibility that your investment might lose value or it might underperform. It might not perform to your expectations. So, you might lose the money that you've invested in, or you might get results that are below your expectations. That's what I mean by risk. So what are some of the things that we need to be aware of, the risks that are associated with fixed term investments? I'm going to share with you four of them in this episode. Let's begin with number one. The first fixed income investment risk is what I'm calling interest rate risk. So there is a risk, especially with the new issuance method for government bonds. There is a risk that if in the future interest rates rise, that will immediately mean that your bond will lose its value. So there is an inverse relationship between the value of the bond and the interest rates. And this normally has to do with the fact that there is always a possibility that you are going to sell your bond on the secondary market. So let's assume that this month it's January. You've gotten yourself a 5-year bond or a 5-year bond at an interest rate, at a coupon rate of 22% per annum. Okay, then maybe 2 years down the line, the interest rates rise for that 5-year bond to maybe 26 or even 30, just for argument's sake. What that would entail is that your bond, the value of your bond on the secondary market will come down because people want to buy new bonds. They would rather go to Bank of Zambia, the primary market, to get a new 5-year bond that is fetching, that is offering 30% coupon rate, and not come get a bond from you on the secondary market. So that will force you to sell your bond at a very cheap price. In those times when you have no choice but to sell your bond because maybe you need your cash. if at the time that you are selling your bond, the interest rates have gone up, it reduces the value of your bond, because you are selling a bond that has a coupon rate of 22. So people will not, people on the secondary market, and our secondary market here in Zambia for bonds, for government bonds, it's a Lusaka Securities Exchange. They would rather buy a new 5-year bond from Bank of Zambia rather than come to get a bond from you on the secondary market, which is Luse, which has a 22% coupon rate. I hope you've understood that. So let's go to the second risk that I want you to be aware of. It's a risk I'm calling the default risk. So this is the risk that the issuer of your bond will default on their debt. Okay, so for government bonds, you are lending your money to government, and obviously this is government that you are lending to. You are not lending to your friend or your unemployed um, uncle or cousin. This is the government that you are lending to. So there is a lower risk. The risk that the government would default on the bond, on paying you coupons, on paying you, at maturity, paying you back at maturity, are obviously very low. But that is not to say there is no risk. There is always a risk that um, the issuer for the bond may not be able to settle their debt in full, and then you will lose out. So this can be a government, or this can be a corporation for corporate bonds. So the default risk or the default risk um, is a risk that you are supposed to be aware of and take into consideration as you decide, to invest your hard-earned cash into fixed term investments like bonds. The next risk is the inflation risk. So what inflation does is that it erodes the purchasing power of your money over time. If you lend government your money today, say 100,000 kwacha for a 10-year bond, in January the 10-year bond was fetching what, about 26, the 24.97%. So you'll be getting your 24.97% coupons every year for the next 10 years, and after 10 years you'll get back your 100,000 kwacha. I think that you and I can agree that the 100,000 kwacha that you get after 10 years, it would certainly not be as, it will not have the purchasing power that 100,000 kwacha now is getting. That's the more reason you are even being given coupons to cushion you against that eroding power of inflation. The other thing is that also assuming that you know the inflation rate is higher than the coupon rate, than the coupons that you're getting every month, every year. It would also mean that you are basically eroding the purchasing power of even the coupons that you have. So inflation risk is one such risk that you are supposed to be mindful of as you decide um, whether or not to invest your money in fixed income risks. Sorry, in fixed income investments. So if the inflation rate is higher than the interest rate on your bond, you will lose money in real terms. The next one is the liquidity risk. So normally when you invest in a fixed income, instrument like a bond, you are normally doing that. There's a very good chance that you are doing that so that you can go full term. Um, Mostly you are investing in a, you are buying a bond so that you can get, if it's a 10-year bond, you want to go full term. But there are times when you need to sell your bond for different reasons. One of them could be that maybe you are in dire need of cash, and you've seen that you have investments like bonds, you have assets like bonds that you can sell on the secondary market, and you need to sell your bonds so that you can realize some money that you need, desperately or urgently. There is a risk that you may not be able to sell your bond when you want to. Okay, for various reasons. I think one of which is the one I've already talked about, because maybe your bond has the value of your bond has gone very low, because at the time that you want to sell your bond, there are higher interest rates that are ruling, and people who would ordinarily come to the secondary market to buy a bond from you are going to the Bank of Zambia to buy similar bonds at a very high interest rate. So you may not be able to dispose of your bond when you want to, and that's a risk that you need to be aware of. The last risk that I want you to be aware of is what I'm calling the call risk. So some bonds are callable. When you look at the when you look at the prospectus for the Bank of Zambia, um, for the GRZ bonds, you will see in the prospectus that there are certain bonds which they specify that the bank, or government reserves the right to redeem those bonds. Specifically, the 6-year bond. Do we have a 6-year bond? The 7-year bond. So we have a 7-year bond, the 10-year bond, and the 15-year bond. Once those bonds have run for a period of, for 60% of their tenure. For example, if it's a 10-year bond, after it has run for 6 years, government reserves the right to redeem that bond. So they can come to you and say, we don't want this bond to continue and we are buying it back. So meaning that you will not be able to realize the full value of what you were expecting to get, assuming that that bond ran its course. So the core risk is one such risk that you are supposed to be aware of. It is not a guarantee that if you get a 10-year bond, you will continue getting your coupons for the next 10 years. After 6 years, after the bond has run for 60%, government reserves the right to redeem that bond, to call that bond back. I think that's about it. That should be the last risk that I wanted to share with you. I want to hear from you what you think about these risks. If at all there's any other question that you have concerning what we are talking about concerning fixed income risks, let me know in the comment section, and I should be able to answer your questions. For me, it's a pleasant evening until next time when we have another interesting topic to